Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. ADISA is committed to thought leadership and delivering insights to the audience. My name is Greg Mausz. I'm your host today, joined by Dr. Sylvia Kwan. She is the CEO and CIO of Ellevest. Sylvia, thank you for being here today.
Thank you for having me. It's great to be here.
So we're going to be talking about how alternatives have become kind of mainstream. They're now an essential part of a portfolio. That was kind of echoed in the theme here at the ADISA meeting. Walk us through kind of the who, the how advisors should be allocating to alternatives.
Yeah, I think you make a great point, Greg. The popularity of alternatives is obviously growing. There's just so many options out there. You know, we're here at the ADISA annual conference. You walk into the exhibit hall, you know, there's just so many sponsors, so many different asset classes. And so if you are an advisor or a representative trying to integrate alternatives into your practice, you're like, oh, you know, who do I choose? What do I do? How do I do it? And I think instead of asking about the what and the how, I think the first question to ask is really the why.
Of course.
Why are you adding alternatives to your practice, right? You know, what are you trying to achieve with alternatives? And I think to answer the why question, you really need to go back to your client's goals. You know, what is the client trying to achieve, and how is alternatives going to help achieve those goals? And that actually is going to help you kind of narrow the field down in terms of, you know, the how and the what. It's going to help you answer the how and the what.
Well, can you unpack that more? Talk more about goal-based investing with alts.
Sure. So goals-based, I think taking a goals-based framework is really important when it comes to integrating alternatives into your practice. And I think of, you know, there's a lot of, I think, very good reasons, but I think there are three primary reasons that I think employing a goals-based framework is very helpful. First, as I mentioned before, it really narrows the field down. So suppose you have a client who's closer to retirement and needs income in their portfolio. You might then focus on more income-generating alternatives, like private credit, for example, or if you have a very young client and they are kind of in a growth stage, they have 40 years, 30 years to retirement, they might be more focused on venture or private equity. And so understanding what the client's goals are kind of helps narrow down all the options that we have in the alternative space. I think another reason is actually client engagement. Certainly we found in our practice that if you use alternatives and explain how alternatives are actually going to achieve a client's goals, when you sit down for that portfolio review, instead of focusing on, oh, did my portfolio beat, the S&P 500 or whatever benchmark, you can talk about how alternatives is helping them achieve their goals. And that actually helps strengthen the client relationship quite a bit. And the third reason is, we haven't talked about this yet, but there's so many different ways to access alternatives, right?
Agreed.
And that field is growing more and more. And so you take something like real estate, for example, there's, closed-end funds and there's interval funds and there's, semi-liquid funds. And so understanding the client's goals and also their appetite for illiquidity, their tax posture, their risk tolerance, all of these things helps you then, again, narrow down the options to make sure that the alternative that you're selecting in the structure that you're selecting is suitable for them.
So that sounds like a very customizable approach.
Yes.
There's also kind of model portfolios that are out there that have alt allocations. That seems a bit more scalable. Walk me through and compare and contrast there.
You're definitely right. Having alternatives as part of a suite of models, for example, is a great way to scale alternatives. It is, in theory, a great solution. I think it's hard to implement. It certainly doesn't mean it can't be, and there are some great solutions that are out there. What I find difficult is if you have a very diverse suite of clients with different needs, different horizons, different tolerances for illiquidity, it may be difficult just to slot them into one of these models. And so in that case, having something that's a little bit more customized might be more suitable.
Thank you for that. When I'm thinking about alternatives and clients, some of them have experience, some of them have good experiences, some of them have bad experiences, but how do you set the stage for the client experience with alternatives?
That's a great question. And it really comes down to client education, which I know we talk about quite a bit, certainly advisor education as well. But I think about it from the, how is the client going to experience this? So most clients understand what stocks and bonds are, for example. They know that if you buy an ETF or a mutual fund or a stock, today you can sell it tomorrow. They have a very good grasp of that. If a client is new to alternatives, that's where we really break it down and help them understand this might be an alternative where you don't invest all of your money at once. There's something called capital calls, or there might be something called distributions, and there's something called a K1, and really preparing that client and putting yourselves in their shoes to help them understand for the life cycle of this alternative, what is it going to be like? And helping set the expectations up front will definitely smooth the path for a more successful alternative experience.
So do you sometimes start off with like an alternative light and then work with clients deeper on, or how do you navigate that? Or is it just completely based upon the individual?
It is based upon the individual, but what we found to be successful is framing alternatives in a context that they already understand. And so we utilize actually a framework that kind of has stocks and bonds in it. And so we have a risk range, for example. And obviously most people know stocks are more risk, bonds are less risk. And so what we do is we map each alternative asset class in that risk spectrum, so they understand, venture is actually more stock-like, beyond the public stock. Something like private credit is more bond-like. Something like real estate, which has income generating and potential capital appreciation, might fall in the middle. And so using that framework helps them understand kind of the risk return profile of the different alternatives. And we found that to be super, super helpful.
That's fantastic, because you do need to lay that foundation and relate to where they are in their educational journey of investing.
Exactly. So the other thing we may do if somebody is really, really new to alternatives, we may start with something that most people understand, like real estate. Mm-hmm. So, where does the income come from? Oh, it comes from the rent collection. Most people will understand that. So sometimes we will start with things that people are familiar with just to get their feet wet and comfortable with alternative investing.
So speaking of that, what are some of the best practices that you've seen out there? Or another way of asking that is, there's people that have made mistakes in allocating to alts, and there's some misconceptions out there. What do you have to say to that?
There are a lot of misconceptions. And I think one of the biggest ones is all alternatives are equal, or they're all the same. We got stocks, we got bonds, we got alternatives. But as you know, alternatives have so many different dimensions relative to stocks and bonds. There's a ton of different asset classes, from different types of real assets, different flavors of private credit, different flavors of private equity. So kind of putting it all in one bucket and saying, I'm either going to, I love alternatives or I hate alternatives. Kind of, it's a lot more nuanced than that. Mm-hmm. I think a second one, from my perspective at least, is thinking always about illiquidity as a disadvantage. I like to think, in some cases at least, the illiquidity can be an advantage.
I agree.
Because that really helps your client really invest for the long haul. You don't want clients to feel like, I want to invest in this alternative and I want to, after 6 months, if I don't like it, I want to sell it. Like you want the client to have a long-term view, and sometimes that illiquidity will help keep them invested, through thick and thin, which is what you want.
Right, and that illiquidity oftentimes causes lower volatility, which makes the client less emotional to respond to market movements or things happening in the news. So alternatives can be very powerful that way.
Yes, exactly.
One of the things I've known about you for years is that you're really passionate about impact investing.
That's right.
So how does the intersection of alts and impact investing happen for you?
That's one of the great reasons I love alternatives, is I feel it is the asset class that has the most potential to make a direct positive impact while generating returns. So if you have clients who want to align their investments with their values, want to make an impact, I think alternatives is actually the asset class where it's most achievable. Because of all the different kinds of underlying asset classes, clients have the opportunity to not only generate returns, but also make an impact. And so a great example would be affordable housing. We obviously have a crisis here in the US, way too much demand, not enough supply. And so development of affordable housing, renovation, preservation of affordable housing is a great way for clients to not only generate returns, but also make a positive impact.
Well, thank you for walking us through how to allocate to alternatives and your kind of unique approach to it. Really appreciate it.
Of course. Thanks for having me, Greg.
And thank you for watching another episode of Focus on Alternatives. Again, for more educational resources, please visit adisa.org, and we'll see you at the next episode.